How's it, Sean from Mel's YouTube book site YouTube channel? Today we're going to be talking about how debits and credits impact your accounts. Alright, so before we get started, subscribe to our channel, it's free, and also hit the notification button so you can get updated on all our future videos. Alright, so let's get started. We are first going to discuss a debit and a credit. When entering accounts in the ledger, it's important to know that each debit entry must have a credit entry in order to balance the accounts. Remember this word and make a note of it. Okay, so debit and credit. You've got your assets on the left-hand side: house, car, computer, TV, fridge, lounge, suite, bank, fixed deposit. Then you've got your drawings, partnerships, money taken out to buy a boat by one of the partners. And you go right down to your expenses: rent or payment of a bond, house insurance, electricity, DSTV, petrol, car insurance, and so forth. As you see, it goes down there. Then on the credit side, we have our liabilities: credit card, Eggers clothing store, house bond, motor vehicle lease, insurance, all that stuff. And then your equities: house, vehicle, capital invested, shares, fixed deposit and bank, minus all liabilities. And then your revenue, income: salary, rent from granny flats, sales of home baked cakes. All right, so everything must balance on the credit and the debit. The totals must be balanced. They must be equal to each other. All right, so the transaction affects the balance sheets as follows. Very important formula: asset equals liabilities plus capital. Right, so here's the chart. You just remember this, write this down, put it on your wall. And whenever you refer back to accounts in bookkeeping, just keep this chart in mind. All right, so with an asset, anything that increases an asset, like your cash or your motor vehicles, anything that you're increasing an asset of, you always debit it. Whenever you decrease an asset, you credit it. All right, I hope you're getting that through. Liabilities: anything that's a liability to a company, when you decrease the liability, you debit it. When you increase the liability, you always credit it. And we'll show this to you now. I'm going to do a couple of little examples so you can understand this. Income received: whenever you decrease the income, right, you always debit it. And whenever you increase your income, you always credit it. Your expenses, your daily running expenses of your company: whenever you increase the expenses to your company, it's always a debit. And whenever you decrease the expenses, it's always on the credit side. Just remember that. All right, so here's an example, example one. For example, we're taking assets now. So we go out and buy furniture. We pay $1,500 to buy a pile of furniture. But now what's happening here? We've increased the furniture that we have now. So furniture is an asset. So if we increase our asset, it's always debited, okay, in the cash book. But now we've paid out money, so we've decreased an asset. We've decreased our money, our cash, which is an asset. So we credit that. If you have a look here again, we've increased our furniture that we bought for the company. So it's increased here. It's a debit. That's the furniture that we've increased. But at the same time, we've decreased the cash that we have. So that's on the credit side. And as you see, there's the asset furniture and there's the asset cash, 1,500, and they both balance. Okay, so furniture increased the asset, like I was just telling you. In other words, there was no change to the equation, and cash decreased. So this was a purchase of a new desk for an office. So what happened here with this equation over here is, on the asset side, there's no change to the equation. It's balanced. Because on the one side, we increased it with the asset of furniture, but we decreased it by the same amount with the cash. So I hope you understand that. So remember this formula at all times and this chart. It helps you. Then you'll understand everything in accountancy. All right, so what's our next example? Okay, example two. You purchase stock for your company. Now remember, inventory or stock is an asset again. So we're dealing with an asset. Remember, asset equals liabilities plus capital. So we're going to increase that asset over there. All right, so we're buying stock. So we're increasing it there. Just keep that in the back of your mind. I'm just going to go back. And suppliers. So we had to pay people to increase that. So it's accounts payable. Now your suppliers is a liability, as you see over there. So we go over here and we look. We're increasing our liability, so we always credit it. So we're increasing the stock we have, and then we're increasing the liability. So we're balancing that. So we're increasing the asset, because that's the stock, by the same amount, and then we're increasing the liability, so they both go up. So there's no change to the equation. I hope you understand that. You see that. $300 and $300 there. Okay, so the books stay in balance because both sides of the equation are increased by $300, as you see in the example over there. All right, so third example. You sold goods to a customer on credit. All right, so that's accounts receivable. Now, accounts receivable is an asset, so you always debit the asset side, which is debit, right? And you credit the sales income because sales is an income. So, for example, we got customers received, accounts received, which is increasing. So, it's an asset which we increase always on the debit side, and income, which is sales. Now, increasing our sales means we credit it because we're increasing it over here, as you see by the drawing over here, the chart here. Very important chart to keep in mind whenever you're analyzing accounts. So that's what we did over there. Asset equals liabilities plus capital. All right, so we're staying on the asset side. So there's no change. All right, cool. So the books stay in balance because both sides of the equation are increased by $100. Okay, so you just got to remember that this debit and credit we've shown is an analogy. In practice, you'll have a customer's account, which is accounts receivable. In that account, this would be on the debit side. Watch my mouse. Customer's $100. And you would then credit a sales account, T account, with $100. Okay, so this is an analogy where they fit in those accounts. I hope I'm explaining that to you now, just to give you an idea of how that chart works, what you debit and what you credit. Okay, so that's it for this video on how debits and credits impact your accounts. So I hope I explained it properly to you. Hope I got it through to you. All right, cool. So please like this video, please share it, and once again, subscribe to our channel. It's free. And also hit the notification button so you can get updated with all our future videos. All right, until our next video, this is Sean from Mal's YouTube Booksite YouTube channel. Good day on you.